This lesson, we're going to talk about retirement accounts and the income that you can get from your retirement savings. So, obviously, you guys know retirement's a specific point in a person's life when they stop working. You can semi-retire or you can fully retire. But when you retire, obviously, that means you no longer have an income from your job. So, you're still going to have expenses that you're going to have to take care of. So where does that money come from to take care of those expenses? Well, you can invest in different types of retirement accounts as you're working. An IRA is the most popular one. It's an account opened by an individual. There's two different types of IRAs. There's a traditional IRA, and then there's a Roth IRA. A traditional IRA, the money that you put in to a traditional IRA is tax deferred. So all the earnings, I should say, is tax deferred until you start withdrawing money from that account. And the contributions that you make to that traditional IRA are also tax deductible. So you get some tax benefits along the way. You get to deduct the contributions. So if you contribute $2,000 to the IRA, you get to deduct that from your taxes. All the earnings in the account is all the earnings is tax deferred until you start withdrawing money from that account. And generally speaking, the age at which you can withdraw from your retirement accounts is either 59 and a half, it's 59 and a half actually. And if you withdraw earlier from that, prior to turning age 59 and a half, then you got to pay a penalty, and it's usually 10%. So the second type of IRA is a Roth IRA. Deposits made into the Roth IRA are not tax deductible. They are taxable. However, when you start pulling money out of that account, all the earnings are tax exempt, which means that you don't have to pay any taxes on the earnings. So generally speaking, the longer that you have until retirement, generally speaking, a Roth IRA might be a better option for you because that money is going to be sitting in a retirement account, earning funds, earning value for a longer period of time. And then when you go to start taking the money out after you retire, then all the earnings are tax exempt. So one thing you have to figure out is, well, how much money am I going to end up with at retirement? Well, there's some formulas here, some calculator formulas. Again, this is the formula for future value. So the future value is equal to however much you're putting in, plus 1 plus the rate over n is the number of times the interest is compounded annually, to the nt power, t is the length of investment in years, minus 1 all over r over n. So as you can see, if you have a situation here, Blythe is 40 years old. She's planning to retire in 25 years. This is going to be T. She has opened an IRA with an APR of 3.8%. So 3.8% is going to be the rate. It's compounded monthly. So the number of times it compounds in a year would be 12 because it's monthly. If she makes monthly deposits of $500, so that's the periodic deposit amount. So that's the 500. The rate would be 0.038 because you got to convert it to a decimal. N would be 12. And she's planning on retiring in 25 years. So T would be 25. So again, you just plug these numbers in your calculator and let your calculator do the work. And if you follow the order of operations correctly, you'll get this much out. So almost $250,000 she'll have at the end of 25 years just by putting in $500 a month for 25 years. So future value. So let's talk about the tax consequences. Let's suppose that her annual contribution was before taxes. So how much did she save in taxes in 1 year if her taxable income for the year was $72,500? Well, her taxable income was $72,500 for the tax year using you're going to see some pictures of some tax tables. So she'll owe $14,475 in taxes. She contributed $500 a month, remember, for 12 months. So her contributions was $6,000. So if she had not contributed to that pre-tax, that would have added to her income. So instead of her taxable income being 72.5, it would have been 78,500. So at that income level, her taxes would have been 15,975 versus 14,475. So because her contributions were tax deductible or tax deferred, she saved herself some money on her taxes. So rather than paying that much, she had to pay this much. So what did she save herself in taxes? Well, the difference between that's $1,500. So she saved herself $1,500 in taxes. You can see the benefit there. Well, what if we're after a future value? Chelsea's 45 years old. Right, sorry. She plans to open a retirement account. She wants to have $300,000 in the account when she retires at age 62. How much must she deposit each month into an account with an APR of 2.25% to reach her goal? So the formula for determining present value of a periodic deposit investment. So B is going to be the ending balance, which is going to be the $300,000. The periodic deposit amount is going to be P, which is what we're trying to figure out. R is the rate, that's 0.0225. N is the number of times it's compounded annually. And we're assuming that this is 12 since she's making a deposit each month. So that would be 12. And the length of investments in years would be when she's 45 and she's going to retire at 62. So the difference between those would be 17. So again, it's a calculator problem. So this is the formula for determining present value of a periodic deposit investment. So to figure out how much she needs to put in the account each month to reach a certain goal. So plug all the numbers into the formula. Let your calculator do the work. Make sure you follow the order of operations, and you get 1208.59. Okay, let's talk about another type of retirement plan called a 401k. So a 401k plan is an employer benefit that they offer their employees. And it basically works like this. If the employee decides to invest money into a retirement plan through the 401k plan, then the employer usually matches a certain portion of that. Okay. So it's an extremely great benefit to the employee because it's basically free money. And it's an excellent employee benefit. So for example, if the employee decides to contribute 3% of their salary to the 401k plan, the employer might match it dollar for dollar. So whatever dollars the employee ends up contributing, the employer will match it. So this is just a benefit that some employers offer their employees. Let's look at an example. Leo makes $75,000 a year. His company offers a 401k retirement plan in which they match 50%, so half of his contributions to the 401k up to 6% of his salary. The company allows employees to make contributions to the 401k to a maximum of 15% of their salary. The maximum allowed contribution to any 401k is $16,500. So there's always some parameters. How much should Leo contribute per month in order to maximize his employer's matching contribution? So the employer will match half of Leo's contributions up to 6% of his salary. So we need to find 6% of his salary. So 6% of 75,000 So 75,000 times 6% would be 4,500. Remember, the employer will only match up to 6%, and that match is half of what they put in. So $4,500 a year is what Leo puts in, which is 6% of his salary. If he puts that in per year, you divide that by 12 to get per month. So when Leo makes a contribution of $375 a month, which is 6% of his salary, the employer will match half of this. Okay, so half of 375 is $187.50. So to max out on what he can put in where his employer will match would be the $375 he puts in and the $187.50 that the employer puts in, and those total $562.50. So this is the amount of free money that Leo will get if he contributes this much. Now he can contribute more than that, but his employer will only match half of the $375. And these other figures here show what he could put in. Remember, he can put in 15% max of his salary. So what he could put in is up to this, 15% of $75,000. Okay? That's below the limit. Remember the limit, the total limit was $16,500. So if he put in the max amount divided by 12 would be $937.50 a month. Now he would not get matched on that. He would only get matched on the numbers that we came up with earlier. So traditional IRAs, Roth IRAs, and 401ks are probably three of the most popular retirement accounts available to employees.